everyone, and welcome to one of our knowledge transfer sessions. Today we're going to be talking about charitable contributions to places like churches or hospitals of your choice. And we're talking about something called the qualified charitable distribution method, which I think if you're middle America, this is probably the way you should be doing most of your charitable contributions. There's one caveat: you have to be age 70 and a half or older. So there's that one little piece there to talk about. But in general, I'm finding most of my clients don't know about this, and generally I'm not seeing this talked about a lot in the industry in general. So let's talk about qualified charitable distributions and, why you should be using this if you're donating to things like churches or hospitals. Once again, my name is John Erickson. I have more than 17 years experience in the financial services industry, and I really love creating these videos. It lets me kind of put out knowledge out there that I think is really valuable to the average person that doesn't necessarily make financial planners a lot of money. In fact, I think one of the reasons this topic alone isn't used a lot by financial services industry is, there's not a lot of easy way to monetize this, and so I don't think this knowledge has been spread out to the masses like it should be. So I'm hoping that this video, illuminates a subject I think is pretty important for a lot of people. My office is next to Overlake Hospital in Bellevue, Washington State, and so a lot of my presentations like this are going to be from a Washington State viewpoint, basically. Because we're going to be talking about taxes today, recognize that today's information has to be treated as general in nature. I think this is going to be accurate for the majority of people, but there's always going to be someone's specific situation can be slightly different. So please treat today's information as general in nature. So what we're going to do is we're going to talk about kind of the historical problem of donating money to charity. And then we're going to talk about what is a qualified charitable distribution, or QCD. And then we're going to talk about some of these secondary benefits of making these QCDs, or qualified charitable distributions. So when I say QCD, I mean qualified charitable distribution. So let's talk about the basic problem with donating charity today. So if you're donating money to charity today out of the goodness of your heart, like say, making a tithe to church, or, giving money to a hospital, that's awesome. You should do things like that. That's great. But you're not getting the tax benefits you historically got, because what used to happen is to take a charitable deduction, you had to itemize. And when you had things like mortgage interest, combined with donations, combined with other things, your itemizations added up to a decent amount, and that's how you deducted money off of your taxes. But we have a massive change to our tax code where the standard deduction went up to a really large number. And the average person, more than 90% of us, in fact, aren't itemizing anymore. We're taking the standard deduction. And when you take the standard deduction, you aren't getting to deduct charitable contributions. So depending upon where your money comes from, I have an example where someone's donating, say, $500 a month to a charity, which is $6,000 a year. And depending upon how that money came to you, say out of your paycheck or out of an IRA, if you are in the 22% tax bracket, behind the scenes you also paid $1,320 federally for that charitable contribution to the charity of your choice, right? Because you had to pay taxes before that money hit your bank account. And so historically, you'd get to deduct that and avoid some of that taxation. But today, because of the standard deduction, you're probably paying the taxes and out of the goodness of your heart, giving money to charities. And there's a way around that. Now, when we talk about the ways we historically get around this, we're going to see a couple problems here. The first is that we could use what's called donor advised fund, or really you're trying to do what's called a bunching concept, where you're going to make charitable contributions over a series of years. And so in 1 year, you bunch all those together. In this case, I say $100,000. And you donate that, year one, to say a donor advised fund, or give it immediately to a charity. And when you do that, you get to take the tax deduction because you're going to itemize that, which is great. But you got to be able to give $100,000, or you have to be able to, as a couple, you have to be able to give more than $30,000 in a year. And for a lot of people, especially we're talking about middle America, that gets start to become outside their reach, basically. And so, bunching concepts are a really good thing to know about, especially if you're charitably inclined. But you have to plan ahead for this. And being a financial planner, the idea of planning ahead is something I live and breathe. But the average person doesn't, and I know that for a fact. part of the reason I have a job. And so the idea that someone's going to do this consistently, it isn't going to be very common. In fact, I would argue most charities are feeling this very keenly. They probably have noticed that over time their their contributions to their charity have gone down, and I think historically we actually can see that charitable contributions have gone down across the country. And part of it is this idea that you're just not getting the tax benefits anymore. That is a secondary piece to go along of doing something out of the goodness of your heart. Now, we also have things called charitable remainder trusts. These could be used as well, where you are going to, say, get income out of something like a rental property or an investment. So you're going to pull the income yourself because you need to live off some money. But you're ultimately setting up for charity someday. But instead of waiting till you die to get the tax benefits, you get the tax benefits while you're alive, which can be useful. But once again, we're talking about putting, say, $1 million rental property in a trust. Do you have that? Does the average American have that? Not necessarily. The average American might be donating $100 a month to charity, $200 a month, right? Good chunks of money, things that are really valuable to them, but don't qualify for the previous two examples reasonably. So enter the qualified charitable distribution, or QCD. This is how we fix this for the average person. And one of the things I'll keep mentioning, you have to be above 70 and a half, because this was originally put into law to kind of mirror the old required minimum distribution rules, where you had to start taking money out of your qualified accounts at 70 and a half as a required minimum distribution. Well, this was put into place to kind of mirror that. But this is still 70 and a half, whereas required minimum distributions are age 73. Okay. And what this is saying is that if you send the money directly from your IRA to a charity, meaning you cut yourself out as a middleman, you direct them to make the check payable to the charity and send it directly there, you now get to deduct it on your taxes. It's actually technically a little bit better than that, because you don't deduct it. It just doesn't count as income. And that's actually better, and I'll talk about why that's better for you. And so, in the previous example, I showed, that you're not getting the charitable deduction anymore. Well, in this case, you get the standard deduction and you get the charitable deduction. So if you do it this way, it's actually better than the old way we used to do it, because, in this example here of someone giving $200 a month, say to a church, and they're paying 12% federal taxes. Well, if they put that money in their bank account and then send the money to the bank account, they'd be paying $288 in federal taxes to give this money to a church. But if you were to, say, send it directly from your IRA, you would now avoid that taxation. And you still get your full standard deduction. And that's good. That's great, in fact. So if you're charitably inclined, this is probably the route for you to go. You have to be age 70 and a half, so that is one issue. A lot of us donate before we're 70 and a half. But I'm finding in this age group, because this is a newer law, that this knowledge to do this isn't out there. And, you should probably be doing it this way. Now, some basic rules around the QCD. You have to be 70 and a half. Okay, pretty simple. You have to have an IRA with deferrals. Pretty simple. There's some minutia things that are not, it's one of those things that it looks like there's a lot on the screen. Probably not relevant for 95% of you except for one thing on here. The one I'll mention is that a lot of people are taking required minimum distributions. If you're age 73 or older, you probably are. And you want to have your charitable distribution come out first before the required minimum distribution. Because if you take your required minimum distributions, let's say you're required to take $3,000 out, and then you decide, and you're like, no, I want that to be charitable later on. You can't fix it later on. You have to go up front. I want the $3,000 to go to the charity, and then it will satisfy your RMD for the year. Or you want $1,500 a month, $1,500 to go to the charity, and you're going to take $1,500 of cash. Well, you've now satisfied half that RMD with the charity and taken the rest as cash, which satisfies the required minimum distribution rules. So if you're under required minimum distribution rules and you're going to use the QCD, so QCD and RMD, you want the QCD to go first. You can donate up to $105,000 annually per person if you're a couple. So for most people's donation needs, this is going to cover the vast majority of donations for Middle America. I mean, Middle America donating $105,000 in one fell swoop. It happens, but not that often. Usually it's closer to death. So basically, it's pretty simple. You have to be 70 and a half. You have to have an IRA. You want to give money to charity. You just send it directly there. But there's some secondary minutia rules, around required minimum distributions. You need to have it come out of your deferrals if you have what's called after-tax contributions, which most people don't have, but it does happen. So some little tiny minutia pieces that probably aren't relevant for most of us, but good to know about, I would say. There's also some secondary benefits to doing it this way. Because this doesn't count as income, there's some kind of cool key features here. The first is this was originally designed to help satisfy RMDs, which is why this starts at 70 and a half. I kind of mentioned this a couple times, but when it doesn't count as income, that means that you don't have to worry about Medicare IRMA. It's not income to you. Social Security taxation can be lower for you because Social Security taxation is based upon your total income, and you don't have this count as income. Property tax forgiveness is often based upon your income. A lot of seniors are living on fixed budgets, and they might not be paying as much in property taxes on their home, and then all of a sudden required minimum distributions slam down on them, and their property tax forgiveness goes away. Well, this covers that too because it doesn't count as income. So this could be an interesting tax tool, secondary benefits-wise, to do it this way. Primary reason you want to do this is you just get the tax savings. Now, that's cool. But there are some secondary pieces to consider here. Now, on your taxes, there's one quirk here. When you first get your 1099, so like if you have your money at Vanguard or Schwab, and you send the money from Vanguard or Schwab to, say, the church you go to, and it's made payable to them and you've cut yourself out of the middle, they will send you a 1099 saying, hey, you took $2,000 of income. You owe taxes. And you're like, wait a minute. John said that this is tax-free. What's going on here? Well, what happens is you actually just, on your taxes at the end of the year, on the line below where you put down how much you got from IRA distributions, you're going to say how much you put on the QCD. And that's the honor system, which means you need your receipts behind the scenes in case you're ever audited, because most taxes are the honor system. And, the audit is always the problem. So if you're audited, you want that receipt from the charity saying you made these contributions. But that's a quirk, right? Because you may not realize that the first time you do it. And that's how this works, is it looks like it's taxable until you file your taxes and you tell the IRS, nope, not taxable. And they just take it off of you, take it off of your taxation, which is cool. Now, there are some challenges, I'd say, here. I think this is the way to go for people who are charitably inclined and above 70 and a half. But you have to fill out a withdrawal form. Some people have trouble getting out of bed and out of the house in the day. And the idea of filling out a withdrawal form, which has terms on there you don't easily understand, even though it can be simple, it can be hard. So that can be a gap, is you have to fill out a withdrawal form one time and have the mental acuity to be able to fill it out. So you might need help if that's the route you're going to go. And it can be simple as filling it out one time, because you might be doing monthly payments, but it can be as complicated as filling it out every time you send a big chunk of money. You need to know ahead of time what you intend to give, because especially if you're trying to avoid required minimum distributions, you want this to come out first. You need to keep your charitable receipts, because remember, it's the honor system on the taxes, so therefore you better keep your receipts in case you're audited. You need to have qualified money to make this work, so bank accounts don't count, brokerage accounts with like stocks in it don't count. And, if you have more wealth, you're probably going to be doing the bunching concept, and a donor advised fund might be better. But every situation's different, and just the ease of doing the QCD may just be all you need to do, because you could do $105,000 a year every year per person. And that's a pretty significant amount of money. So I hope this is helpful. When I looked at this concept, like, well, this is pretty easy, and it makes total sense to me. But for you, it may not. So if you have questions, if you have follow-up things you want to bug me on, feel free to drop me an email or call me in my office. In general, most of these things are just people needing to ask a question and getting some basic feedback. Totally happy to do that. And from there, I hope you enjoyed this video, and we will continue to push these out and try and spread knowledge out there in the financial services industry. Thank you.